Good morning, everyone, and welcome to today's webinar. I am Chris McCauley, Benefits Attorney with ProBenefits. Today's presentation is an update on health savings accounts and employer options surrounding health savings accounts. I am joined today by Kim Malliolo. Kim is a benefits consultant with ProBenefits, and among other things, she is an HSA expert. So that's why we wanted to have her on today. She's an expert in HSA compliance, plan design, and all the practical issues surrounding HSA. So we're happy to have Kim on today. Today is our February session in our 2016 ProBenefits Client Webinar Series. The next presentation will be March 15th, and it's a short mini webinar or refresher on mid-year qualifying events. As always, a copy of the slides and a recording of the presentation is going to be emailed to all participants and registrants following the presentation. If you have any questions during the presentation today, you can utilize the question box on the control panel on the right side of your screen. So submit those questions in writing, and we will answer them and do the best we can to get to as many as we can during the presentation. Just a quick outline of today's presentation. We're going to do a quick refresher on HSA eligibility, contributions, and distribution basics, essentially the main compliance requirements for HSAs. We're going to walk through a couple of plan design examples, and then finally we're going to answer your questions at the presentation. So with that, we're going to jump into the presentation. Health savings accounts, or HSAs, they have been around since the second Bush administration, 2004, but they are growing in popularity. And essentially what an HSA is it's a trust or a custodial account, and it's used as a vehicle to pay for eligible medical expenses pre-tax. And as we're going to talk about in the next couple of slides, contributions to the HSAs, the interest growth from the HSAs, and all distributions are tax-free if used to pay for eligible medical expenses. I think the main distinguishing factor between HSAs and some other benefits like flexible spending accounts, FSAs, and health reimbursement arrangement, HRAs, is the fact that the HSA is an individual account. The FSAs and HRAs are generally employer accounts. They're employer funds. The employer holds the funds until they are used to reimburse medical expenses. If there are no medical expenses or they're not used for that purpose, then the employer gets to keep those funds for the FSAs and HRAs. But that's not the case for health savings accounts. They're individual accounts. The account belongs to the participant. So once the money is contributed to the participant's account, it can't be given back to the employer, or the employer can't take it back. If the account holder terminates employment, they take the HSA account along with them. The employer can certainly be a part of setting up and contributing to the HSA account, but employer participation is not required. An individual that qualifies for an HSA account can go open an HSA account individually without any employer involvement at all, but it is possible to do it through the employment relationship as well. Contributions, again, are non-forfeitable. As I said earlier, if the employer leaves employment, they take that money with them. And then finally, the compliance responsibilities. Unlike the FSAs and HRAs, because these are individual accounts, most of the compliance responsibilities fall on the individual account holder. The employer has a few responsibilities if they are contributing to the HSA, or if they are allowing individuals to contribute through a Section 125 plan. The employer has a few responsibilities to make sure that the employee is eligible to participate to the HSA, but that is pretty much all of the compliance responsibilities for the employer. Most of the rest of the responsibilities fall on the individual account holder. Let's talk quickly about who can contribute to an HSA. The HSA eligibility requirements, and again, this is who can contribute to the HSA. We'll talk later about who can get disbursements, but in terms of contributions, in order to make a contribution to an HSA account, an individual first must be covered under an HSA-compatible high-deductible health plan. And high-deductible health plans have minimum deductibles and maximum out-of-pocket limits. In 2016, the individual minimum deductible for an HSA-qualifying high-deductible health plan is $1,300, and the minimum deductible for family coverage is $2,600. So that is the first main requirement for HSA eligibility, is to have high-deductible health plan coverage. The second main eligibility requirement is to not have disqualifying coverage. So we're going to talk about this on the next slide, but the participant cannot have first dollar coverage under the minimum deductible under any other health plan. Beyond those two main eligibility requirements, I wanted to talk about a couple of groups of individuals specifically. First is company owners. Those of you that are familiar with the FSA and HRA rules may know that for the most part, owners of certain business entities, sole proprietorships, partnerships, S corporations, those individuals are not eligible generally to participate in FSAs or HRAs. However, those individuals are eligible to open HSA accounts. So those owners can open HSA accounts. They may not be eligible to make pre-tax contributions through a 125 plan, but they are eligible to open the account and make contributions to the account and takes the tax deduction on the contributions when they are filing their income taxes. So they can still participate in the HSA pre-tax. There are two groups of individuals that are not eligible to participate in an HSA even if they meet the two requirements we discussed above, and those are tax dependents and Medicare recipients. So those two groups of individuals, it's pretty much a blanket restriction, are not able to contribute to HSA accounts. And then finally, eligibility is generally determined on a monthly basis. So you can be eligible in January because you have a high deductible health plan, but if you don't have a high deductible health plan in February, you lost that coverage, then you would not be eligible to participate in or contribute in February. So eligibility is generally determined on a monthly basis, especially for contribution purposes, and we're going to talk about that a little bit more in the following slides. I wanted to expand just a little bit on the second main requirement we talked about in the last slide, and that's the requirement that the HSA account holder have no first dollar health coverage other than high deductible health coverage. And that obviously includes a group health plan that provides first dollar coverage, but it also includes some of the other health plans that may not immediately come to mind. First, a general purpose FSA would be disqualifying health coverage. So an FSA that pays first dollar for participants, someone that is covered by that general purpose FSA would be ineligible to contribute to an HSA. The same thing with certain HRAs. Kim's going to talk in a little bit about certain HRA designs that are HSA compatible, but some HRA designs that pay first dollar are disqualifying coverage. And then also some military benefits, TRICARE, and certain VA benefits. Someone that has received benefits at a VA hospital in the last 3 months may be ineligible to contribute to an HSA. This rule also includes coverage under the FSA or HRA of a spouse or parent. So it doesn't matter that it's your FSA or your HRA. If you are covered by one of those plans, whether it's under a spouse's plan or a parent's plan, then potentially you are ineligible to contribute to the HSA. In terms of ineligibility, it is actual coverage that is important. So someone that is eligible for another high deductible health plan but is not enrolled in that coverage, that person is still HSA eligible. It's only if that person is enrolled in the other plan do they become ineligible for the HSA. And again, as Kim's going to talk about in the future slides, There are special plan designs that can provide additional coverage and still preserve HSA eligibility. We have a couple examples here, but I'll let Kim explain those in the next couple of slides. Moving on, let's next talk about Hsa contributions. You can see the contribution limits for 2016 here on the slides. An individual that is eligible for the full year can contribute $3,350. Someone that has family coverage eligibility for the full year can contribute $6,750 for 2016. And just note that some individuals, those that are 55 or older, may make an additional $1,000 catch-up contribution each year. As we talked about, the HSA can be funded by both the employer and the employee. Those contribution limits apply to both of those contributions. So the employee plus employer contributions cannot be in excess of those limits. The contributions, again, are excluded from taxable income of the participant, either if they are done through a 125 plan or if the employee takes the deduction when filing their income taxes. The maximum contribution limit is generally determined monthly. What I mean by that is if an individual is eligible for 6 months during the year, they can make 1/2 of the maximum annual contribution. That's the general rule. That contribution limit is determined monthly. However, there's a really large exception. That exception is the full contribution rule, which essentially says any participant that is HSA eligible on December 1st and remains HSA eligible through the following calendar year can make the full annual contribution that first year. So that's really a large exception to the general rule that the maximum contribution limit is determined monthly. Oftentimes, employers contribute to HSAs on behalf of their employees. There are really two approaches. First is outside of a 125 plan, and then second, employers can contribute through a 125 plan along with their employees. Contributions outside the 125 plan, strict comparability requirements apply to those contributions. What that means is employers generally are not free to vary the contributions for different employees. Essentially, all employees that are similarly situated with the same health plan and same tier of coverage should receive the same contributions. The same is generally true through the 125 plan. Those contributions are subject to discrimination testing. So although there's not a blanket restriction on varying contributions through the 125 plan, because of the discrimination testing, generally it is recommended that the contributions through the 125 plan are the same for all similarly situated employees as well. In short, no matter how the contributions by the employer is made, generally the contributions should be the same for all employees. Let's talk quickly about HSA distributions. Distributions are tax-free for qualified medical expenses. Qualified medical expenses are those outlined in 213D of the IRS code. Not identical, but very, very similar to FSA eligible expenses. A qualified medical expense is any expense for the account holder, a spouse, or tax dependent. And they are any qualified medical expenses are those that are not reimbursed by any other source. There's not many restrictions on distributions. Again, it's tax-free for medical expenses, but the account holder can take a distribution for any purpose, generally at any time. Now, a distribution taken for some reason other than a qualified medical expense could be subject to taxes and excise taxes on those distributions, but the participant is not prohibited from taking distributions for those reasons. There's really only reasonable restrictions on the frequency and minimum distributions. So the account custodian could say that a distribution can only be taken certain times and certain amounts. Distributions are not affected by eligibility. Eligibility only restricts contributions. So someone that was HSA eligible, had an HSA account, had distributed funds, is now no longer HSA eligible, but they still have some funds. They can still use those funds for qualified medical expenses, even if they are no longer HSA eligible. Expenses, in order to be a qualified medical expense, they must be incurred after the HSA is established. Generally, the rule that is, in order to be established, the HSA must be funded, so there must be some money in the HSA. Simply opening an account is not enough to establish the account. Some money must be deposited into the account. And then finally, there's not really a limit on when distributions can occur, so as long as the expense was incurred after the HSA was established, the participant can wait and receive the distribution later. They can shoebox those receipts and get the distribution in future years. Finally, the one thing I want to talk about, the last thing I want to talk about is the reporting requirements that are required for HSAs. The employer has responsibilities only if the employers are making a contribution to the HSA or if they are allowing employees to contribute through a 125 plan to the HSA. If that's the case, then the employer must report on the W-2s. They would report the amount of contributions in box 12 of the Form W-2 using code W. Finally, the main reporting requirement is for the account holder themselves. The account holder is required to report the contributions when filing their taxes. That is done by attaching Form 8889 to the 1040 when filing individual income taxes.
Chris, this is the moderator. We've had some good questions from participants, most of which have related to eligibility. So I'm going to go backwards just a little bit and ask you a couple of quick questions on eligibility. First of all, can you say just a word about, you mentioned, I'm going to go back to the slide, that in order to be eligible, an individual must be covered under a high deductible health plan and then not have any disqualifying coverage. Can you say a word about what disqualifying coverage may be, including the impact of any unique employee benefits that may be available to the individual, such as telemedicine or an on-site health clinic sponsored by the employer?
Yeah, so disqualifying coverage is essentially any coverage or any plan that provides benefits, includes first dollar reimbursement for benefits under the maximum deductible health plan. So any plan that provides benefits, any health plan that provides benefits to the employee before they have met their maximum deductible. So we talked about FSAs would be one. Another group plan would be another disqualifying coverage. You mentioned telemedicine. Telemedicine is a benefit that's often forgotten when discussing HSA eligibility, but potentially telemedicine could be disqualifying coverage if those benefits are provided to the employees. If those benefits are provided to those employees before the employee meets the minimum deductible for the high deductible health plan.
Thank you. And several other the questions have related to the effective date, and I'm going to go back on the distribution slide. You mentioned that expenses to be eligible to be reimbursed tax-free from the HSA bank account, that expenses must be incurred on or after the date that the HSA is established. Several of our questions have related to what are the options for an individual who has been on a high deductible health plan. Maybe they had an FSA or maybe they had an out-of-pocket HRA, but an individual has been under a high deductible health plan, but let's just pick a date and say the health plan is renewing January 1st. What are the options in terms of when that person can open the HSA bank account, and then what expenses would be eligible for tax-free contribution or distribution after that date?
Yeah, so let's assume someone was covered in 2015 under an FSA. So they would be ineligible for all of 2015 in order to open the HSA account, even if they were covered by a high deductible health plan. Let's say on January 1st of 2016, they're still covered by the high deductible health plan, but they're no longer covered under the FSA, so that would be the date that they are eligible to contribute to the HSA. And at that time, as soon as they do make that first contribution, that's the date when expenses can be reimbursed. So let's say they make the first contribution on January 1st. Any expenses incurred on the 1st or after could be reimbursed by the HSA account. Any expenses incurred prior to January 1st would not be eligible under the HSA, but once the HSA is funded, then the expenses would be eligible.
Thanks, Chris.
And with that, I think, Kim, I'm going to pass it over to you to talk about some plan design options.
Great. Thanks, Chris. Hi, everybody. As Chris said, I'm a benefit consultant with ProBenefits. We're going to talk about some plan design examples here. As Chris had mentioned before, one of which is an HRA that wraps around the minimum deductible requirement of the $1,300, $2,600 for family for HSA eligibility. In this example, we have an insurance plan that has a $3,500, $7,000 high deductible. Before the insurance kicks in, some employers might want to, quote, buy down that deductible responsibility for their employees while still preserving the HSA eligibility for the individual. They can wrap around an HRA behind the minimum deductible requirement of the $1,300, $2,600. In this example, they could possibly contribute to the HSA if they would like, or just leave it up to the employee to contribute. The $1,300, $2,600 is just the minimum requirement. They could also set that deductible at $2,000, $4,000, and have the employee responsible for some or all of that deductible before the HRA kicks in. That would preserve the employer's responsibility of contributing if expenses are not incurred under the HSA portion, yet preserving the individual's ability to fund for that deductible or other dental, vision, or post-retirement expenses, as well as post-retirement income as well. Go to the next example. In addition to the HSA, a simple dental and vision HRA can be put in. This really doesn't have any coordination with the HSA as our prior example, but allows for the employer to fund dental and vision expenses that is allowable without making the HSA qualification ineligible. This would just be an additional benefit that an employer would put in to reimburse employees for dental and vision expenses in addition to their HSA. In our last example, we put in all of the alphabet in some of the more complicated plan designs that we have. And again, another benefit for using our benefit consultants, we can help employers create different combinations of these plans to allow employees to maximize their tax savings, maximize the employer's contributions, and also the availability of all the benefits that an employee could have with all of the combinations. In this example, we put in the HSA. We also have the wraparound HRA for deductible expenses, but then add in a limited purpose FSA that would cover dental and vision expenses, similar to the prior examples HRA, but this would be employee contributions. And one of the reasons that an employee would want to do both the HSA contribution and a limited purpose FSA, in my personal example, when my child was going through orthodontia, it was nice to have that money in the limited purpose FSA as an extra tax deduction, and also for the upfront cash flow that we could pay the orthodontist upfront, then just have it deducted pre-tax out of the remaining paychecks of the year. The limited purpose allows that cash flow feature just as the regular FSA. It also allows the person who's trying to fund for retirement through the HSA or for just funding the maximum pre-tax amount that they can fund in the year, the additional limited FSA allows for that additional tax savings. As with all the HRAs that are linked to a medical plan, they must be linked to the enrollment in the high deductible health plan. Our Hsa solution includes a few unique features that I find. We have the account set up online. Employees set up the accounts within a matter of a few minutes. The employer portion of the setup, if it was an employer subsidized plan, takes very little time to set up. There's no documents, no testing, besides the discrimination testing that Chris had mentioned. As far as the plan goes, no summary plan description requirement to provide to the employees. The accounts are all maintained online, with the employee being able to work with their own online account just as they do their bank account. One of the options that we have is investments in mutual funds. Once the account balance reaches $1,000, participants are able to invest in a variety of mutual fund options. This allows people who are looking for that additional retirement funding, which I'm finding a lot more people are focused on additional savings for retirement. This allows a person to invest that money in actual mutual funds, to invest for funds to pay for post-retirement medical expenses. Most financial planners I'm working with suggest that people put away $6,000 to $8,000 a year for post-retirement medical expenses, medical, dental, and vision, and this allows for that growth to be actually invested in an option to gain some interest. We have the Mastercard, similar to our FSA and HRA cards, which are merchant category debit cards that are only allowed to be utilized at proper vendors. We also have a unique feature, which is the Claims Vault, which allows people who have received a distribution from their account to upload a copy of the receipt, which is stored electronically. For anyone who might have an audit in future years, they will be able to produce their receipts because they've been stored electronically on our website and categorized in their account. Another unique feature that we have, I believe, one, if not the only, vendor who prepares the Form 8889 on the website. Participants go to the website at the end of January, print their form, and either provide it to their accountant or go on their TurboTax and complete the 8889 with the information that's already been populated on this form for them. We track the contributions and balances for the accounts to make sure that no one has over-contributed to the year. We identify any that have exceeded and provide information on how to correct that mistake so there's no excise tax provided to the employees. People ask quite often, why would I use ProBenefits for the HSA? Maintaining some plan design is one of the benefits I find. We can also communicate that plan design to the employees. We set up the plan design so that it's compliant, running through the cafeteria plan, as well as in combination with HRA and FSAs. We are an independent administrator, so even if your HSA that you're currently using is tied somewhat to the insurance company that you're using, when you change that insurance company, because that usually happens at least every other year, if not every year these days, you do not have to change the administrator for the HSA. You don't have to roll over funds, change the funds, get a new card. All of that change process goes away when you have an independent administrator. Our staff is experienced in HSA rules and regulations, communicating that to employees, and helping them to administer their HSA in the best possible way for their particular situation. If you'd like additional information on any of the topics that we covered today, we can provide that to you. Just send us an email. There's also a publication 969 available at irs.gov that gives you all the IRS technicalities of HSA administration. Frankly, you could probably send us an email and have us translate it much easier. We have administration for flexible spending accounts, HRAs, HSAs, as discussed today. In addition to that, also the premium-only plans, COBRA administration, and transit accounts. Some of the cities across the country now are mandating transit plans. We do administer those as well as the other plans discussed. We provide Form 5500 preparation and ERISA compliance, ACA education and training, and as the two gentlemen here on the call with me today, our benefits attorneys are on our staff to assist with any questions that you may have as your plans are in function, and any compliance issues outside of those that may arise that you need assistance with, we'd be happy to help you.
Kim, your friendly moderator here. A couple of questions I think relate to just practical distributions. Chris went over the rules about distributions, what can be reimbursed. Can you talk just a little bit about practically, let's say an individual's got the HSA bank account, contributions are being made either by the participant or the employer or both, and now the participant starts incurring these eligible expenses. Can you just talk practically about the card, and then if the card is not used, how the individuals get their money out of the account?
Sure. The easiest method is using the card. Obviously, when a participant incurs an expense, they can use the debit card at the point of service or to pay an invoice that they receive from a provider. The other way, as Chris mentioned, the shoebox effect, if a participant wants to shoebox their receipts for a time in the future, 5 years, 10 years from now, they can pay themselves back for those receipts by simply going onto our website and then transferring the money from their HSA to their personal bank account, just like they would do any other online banking transfer. If a provider did not accept a Mastercard, some of the smaller providers may not accept Mastercard, they could do this in the same fashion. They can transfer the funds from their HSA to their personal bank account and then simply write a check to the provider from their personal bank account.
Very helpful, thanks. We listed earlier, I'm going to go back to the slide, we listed the Hsa contribution limits for 2016. Again, as Chris said, $3,350 is the individual employee only amount, family amount $6,750, and then there's a $1,000 maximum catch-up contribution. Some of the questions have related to, what are the other maximums or minimums related to HSAs? One of the questions was, if we establish the account, is there a minimum that has to be put in the account? Generally, the answer to that is no, there's not a legal minimum, but practically, since the accounts do, there is a monthly account administration fee that's usually in the range of $3.50 per account that's either paid by the participant or by the employer. Generally, you need to put some money in the account for it to be cost positive. The minimum deductibles on the HDHP plans in order to even be eligible for HSA bank account coverage are for 2016, $1,300 is the individual employee number, and $2,600 is the minimum deductible for family coverage. And then also there's an maximum out of pocket. So to be HSA eligible, the plan that you're enrolled in not only has to meet the minimum deductible, not only can it not have copays or any other first dollar coverage, but also those plans have a maximum out-of-pocket limit of $6,650 for individual coverage, or $13,100 for family coverage. Otherwise, I think we've addressed the questions. If you've submitted a question in writing that we haven't gotten to yet, we'll get to it here in the next few minutes. And if you'd like to email Chris or Kim with any questions following the session today, they'll be happy to assist you. So to everyone, thanks for joining us, and hope you have a great day.